Howdy, everybody. Welcome to Liberty Call. Today is Tuesday, September 24th, 2024. Hope you're having a fantastical day out there in the interwebs. It is a beautiful day here in Colorado. Lots of sun, no clouds, cool breeze. It is wonderful. So, wish you were here. You should come up and visit. Anyways, hope you're having a great day. Like I said, before we jump into the numbers, markets look pretty good today. Well, sort of. But if you could do me a favor, if you could give me some thumbs up, a like, a share, subscribe, follow, and press that notification bell. All righty, well, let's go ahead and jump into the numbers. Domestically, things looked okay. Dow Jones was up 0.2%, 83 points, closed at 42,208. S&P 500 up 0.25%, 14 points, closed at 57,32. NASDAQ up 0.57%, 101 points, closed at 18,076. The VIX down 3.15%, it's at 1539. Canada up 0.24, Brazil up 1.22, and Mexico up 2.2%. Wow, big jump there. Over in Europe, Germany was up 0.75%, the UK up 0.28%, France up 1.28%, Netherlands up 0.41%, Spain up 1/3, Italy up 0.6%, Switzerland up 0.51%, and Portugal up 0.4%. Russian exchanges both green again today. MOEX up 1.84%, RTSI up 1.9%. And the overnights, the Nikkei in Japan was up 0.75%, Australia down 0.13%, New Zealand down 0.52%. In China, the Shanghai was up 4.15%, big jump there. Looks like a big jump across most of these. Shenzhen Component up 4.36%, China A50 up 5.14%, DJ Shanghai up 4.12%, Hang Seng up 4.13%, and the Taiwan weighted still has not been open. All right, so wow, Asian markets really, jumping and jiving. All right, let's get to the market recap. Dow, S&P 500 ride, Nvidia surged to close at a fresh record highs. On Tuesday, the S&P 500 and Dow Jones Industrial Average reached new highs, buoyed by gains in tech stocks, particularly Nvidia, despite signs of consumer anxiety about the economy. Nvidia surged nearly 4%, leading the broader tech sector. This rally persisted even though Nvidia halted orders for its H20 chips to comply with the U.S. export ban on semiconductor equipment going to China. All right, consumer confidence declines. The Conference Board Consumer Confidence Index dropped to 98.7 from 105.6 in August, marking the sharpest decline in 3 years. The primary concerns were inflation and job stability, signaling consumer unease about the economy. Federal Reserve speakers, including Governor Michelle Bowman, cautioned against aggressive rate cuts, noting that inflation remained above the Fed's 2% target. Bowman, who opposed the recent 50 basis point rate cut, emphasized the need for a careful approach. Minneapolis Fed President Neil Kashkari suggested that the pace of future cuts may slow, while Atlanta Fed President Raphael Bostic indicated that economic normalization was progressing but did not foresee rapid rate cuts. The Fed's recent rate cut signaled the start of an easing cycle with expectations for 125 basis points in reductions before the end of the year. If you remember yesterday, we were talking that whoever we were quoting said that they foresaw 74 basis points of cuts before the end of the year. So somewhere between 3/4 and 1 1/4. And last in corporate news, Boeing fell 0.9% after offering a new labor deal to its 30,000 striking workers. Visa dropped more than 5% as the U.S. Department of Justice filed an antitrust lawsuit alleging anti-competitive debit card practices. All right, so that's all the news for today. Let's get into next article I had here. It comes from Zero Hedge. It's titled Navigating the Market Post-Rate Cut. This was authored by Lance Roberts of realinvestmentadvice.com. So let's see what Lance had to say. Last week, the Federal Reserve made a notable decision by cutting its overnight lending rate by 50 basis points, the first such move since 2020. This aggressive cut, typically seen during economic slowdown, signals the Fed's efforts to support the economy amid weakening data. Historically, similar cuts have led to varied market reactions with both positive and negative outcomes, depending on the broader economic context. Historically, after a 50 basis point cut, markets have shown short-term gains as seen in 2001, 2007, and 2019. However, deeper economic issues often surface later, leading to significant market corrections as happened during the dot-com bubble and the 2008 financial crisis. Certain sectors tend to benefit more from rate cuts. Large cap stocks, particularly in consumer staples, technology, and healthcare, often rally due to improved access to cheaper capital. Small cap stocks also may benefit, but their response tends to be delayed, especially if recession is looming. Bonds, particularly long-term treasury bonds, perform well as rates fall. Real estate investment trusts, or REITs as we call them in the industry, and gold also tend to benefit due to lower borrowing costs and a weaker dollar. Despite potential short-term gains, risks remain. Key concerns include the upcoming U.S. presidential election. That's going to be a nightmare. A potential recession, geopolitical tensions, and the impact of the Japanese yen. Investors should proceed cautiously, focusing on risk management and staying alert of changing economic conditions. While market momentum remains bullish, it is essential to remain cautious and prepared for potential downturns, because they can happen anytime. All right, got one more article here, also from Zero Hedge. So the economy now depends on stocks, which depends on front-running the Fed. And this is fine. This is written by Charles Hugh Smith of via up2mindsblog.com. All right. In his article, Charles Smith critiques the U.S. economy's reliance on the stock market and the Federal Reserve's interventions. He argues that the current economic system, driven by asset bubbles and the wealth effect, primarily benefits the top 10% of wealthy individuals who own most of the assets. This group's spending, which drives much of the economy, is fueled by stock and housing price gains rather than underlying economic strength or building stuff and selling it for a profit. I know, it's crazy. Those companies used to pay good dividends. Those companies are still out there, but unfortunately, people like to chase, growth returns, which oftentimes wind up kicking you in the you-know-whats when things turn the other way. All right, the system, which Smith calls neo-feudalism, keeps the bottom 80% of Americans in a state of financial hardship and debt. Sounds like fun. Smith points out that the stock market's gains are not driven by solid fundamentals, but by anticipation of the Federal Reserve's monetary stimulus, such as interest rate cuts. Investors, especially the wealthy, front-run these cuts, causing asset prices to rise artificially. He suggests that this creates an unsustainable cycle where the economy depends on the Federal Reserve's actions rather than real economic growth. The article highlights the risk of this system failing if the Federal Reserve's future interventions do not continue to push stock and housing prices higher. He also warns that the changing global economic conditions, such as China's economic stagnation, could disrupt the U.S. economy's dependence on asset bubbles. Smith suggests that this economic model is unsustainable and may face a significant reckoning, as it is based on enriching the wealthy at the expense of the broader population. Yeah, I would agree. I mean, I'm not so doomerish as Mr. Smith here in his article or in his view of things, but it is definitely irritating. From my point of view, as someone who is buying and selling securities for my clients, that there are people who get the news ahead of time, and so they position their assets. Nancy Pelosi, and. So that, they get returns that are just obscene. And then, I got to deal with conversations like, well, how come I don't get returns like that? Well, because I don't get a phone call, or I'm not doing legislation ahead of time on, I don't know, self-driving cars or electric cars or whatever it might be. And then, dumping my holdings or buying options, ahead of time on, information that I know is going to pan out. So anyways, all right. Well, that's everything that I had for today. If anyone needs anything from me, please go to DSA Financial Group.com. That's where you can go get all your financing needs addressed. So feel free to give me a buzz. All right. Well, I hope everyone out there has a wonderful evening, and I shall talk to all y'all again next time. Adios.